Hello there, everyone, and thank you so much for watching one of our weekly webinars here. I'm Sam, and I moderate these weekly webinars. And in just a second, we'll be joined by Michael Corgett, who's going to be covering some of the more popular RMD tax traps we hope you'll avoid by watching this presentation. After Mike's done speaking, he's going to be bringing me back on to answer some of the questions we've received from you. I apologize in advance if we don't get to every question. We do like to keep these presentations short. We try to respect your time. If we don't answer your question live today, I will make sure that it is fielded to one of our financial advisors to answer either through email or over the phone with you after the presentation has ended. In the chat box, you're going to see some links. They're going to guide you to our calendar where you can book an appointment, or to our complimentary cash flow analysis, which Mike will go more into depth with you about throughout his presentation. And as a reminder, we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors here. So please keep that in mind as you're listening along today. And without further ado, let's jump right into the content with Michael Corgett.
Thanks, Sam.
No.
Thanks, everyone, for joining me today or joining us today. We really appreciate it. Today, we're going to talk about a couple of subjects that many people don't think about: qualified charitable deductions, and probably more people think about required minimum distributions, or RMDs. The rules have changed on RMDs, and that's what we're going to talk a little bit about today. And then some examples on both QCDs, qualified charitable deductions, or RMDs, required minimum distributions, state taxes on RMDs, and does my spouse help on an RMD? Technically, she does not. She or he does not. The RMD percentages, the factors that apply based on your age, are essentially the same for male and female. There's no joint or couple rate, so just please keep that in mind. But some people think, well, do I get a break because there's two of us? And that is not the case. Let's go ahead and dive right in. The eligibility for a qualified charitable deduction: you must be older than 70 and a half. 70 and a half was the original and the long-term age that you had to start making required minimum distributions. Now that has changed, and I'll talk about that in a minute. But applicability for QCDs that do apply to distributions that have to be made or are made from a traditional or rollover IRAs and certain other retirement accounts, i.e. Pension plan values or 401k accounts, just to name a couple, are all applicable. Let's talk about what the limits are for a qualified charitable deduction and some of the tax advantages, and then a couple of scenarios that I think you will find helpful. The limits are simple: $105,000 per individual times 2 for a married couple. So up to $210,000 can be utilized and deducted against ordinary income. Okay, it's a large sum of money that can be used as a deduction against all income for tax purposes. Excuse me. And how does that relate to RMDs? Well, what we're going to talk about is sort of linking the two together. The tax advantages of a QCD are excludable from all taxable income. It is one giant deduction. Your income is adjusted by the amount of money that you choose to donate through a qualified charitable deduction program. It does benefit you in these regards. For those of you who do not itemize your deductions, you just take the standard deduction, you still get a benefit. It is a reduction against your ordinary income. And comparing that with traditional charitable deductions, there are limits. Number one, you have to itemize your deductions, which many of us don't do anymore, since the standard deduction was more or less doubled during the 2017 Tax Act. So if you do like to give money to charity, and I know I do, and a lot of people still do, if you don't itemize, you really don't get the benefit of that charitable deduction. But using a QCD, you will get that benefit. And we're going to talk about tying the two together with an RMD. It is a way to give to charities that you care about, all right? And it has a dual benefit by fulfilling your philanthropic goals and the tax efficiency, keeping both of those in mind. If you have charities that you really, really believe in, a QCD may make the most sense for you if and when it does, the timing of making a distribution from an IRA makes sense, all right? There are important rules that need to be adhered to. You can get all this information by reaching out to us, and we'd be happy to talk more in depth about it with you. You can always go to the IRS's website. And also, I'm not a tax advisor. I do know a lot about tax treatments and tax planning, but I am not a tax professional. So you will want to consult a tax professional, but as a financial planner or a financial advisor, I could definitely give you some guidance and some advice, but you're going to want to talk to a tax professional just to make sure you're doing things correctly. So here's our first scenario, a simple one. John is 75 years old. He has a traditional IRA. He has to take a required minimum distribution of $10,000. He wants to donate half that money to his favorite charity. How does this work? A regular withdrawal, John would take the full $10,000 out, and it would be taxable income, all of it that year. It would also be subject to potential limitations or taxation on other income, including your Social Security benefits, because Social Security benefits can be taxed at one level at certain rates, and then with additional or higher income can actually be taxed at even a higher rate. I should say the portion of your Social Security would be taxable. That amount would be increased depending on what your overall income is. But bottom line, the $10,000 distribution is taxable income, and it could affect a lot of things. But if you choose to, as in John's case, give $5,000 of it directly to a charity, he gets essentially a $5,000 reduction in his ordinary income for that given year, as you could see right here in this example. Outside of the other $5,000 is taxable income to John, and he's going to do whatever he needs to or wants to do with those monies. So he satisfies, again, he's charitable, and he gives some money to his favorite charitable organization, and he obviously, the other portion, he'll do what he feels comfortable in doing with it. Our second example, I'm sorry, we're finishing up with John. Without the QCD, again, John's going to pay tax on the full $10,000. With it, he's only going to pay tax on $5,000. The other $5,000 is a reduction of his taxable income, and it goes to his favorite charity. Now we're going to talk about Jane, who is also 75 years old. She has to take an RMD. Hers, in this case, is more significant. Her IRA was probably a little more successful and obviously much larger, and her RMD is $120,000. She wishes to give the lion's share of that money to a charitable organization to take the charitable deduction. Well, again, the regular withdrawal, Jane would have to take the full $120,000 RMD from her IRA, and it's all taxable. The tax implications, again, can affect her Social Security taxation, as well as some of the phase outs for deductions. Itemized deductions could affect it because of the amount of the income coming in. We all, we are all taxed in various marginal tax rates, but as you get into the higher tax rates, certain deductions that you do itemize can be reduced and or eliminated altogether. And again, I stress talking to a tax professional about that. But again, in Jane's case, she's going to instruct her IRS custodian to send $100,000 from her IRA directly to the charitable organization or organizations. You could do this to multiple organizations. In other words, you can divide it up, and only $20,000 is taxable income for Jane that year, because she's taken $100,000 of her IRA, which she would normally have to take out and pay taxes on, and then spend the balance. She's given it to the charity or charities of her choice. So, you get your cake and eat it too, which is kind of neat. And again, a comparison, without the qualified charitable deduction program, 120 is taxable. With it, 100,000 goes to a charity, and only 20,000 is taxable. Pretty cool. Let's talk a little bit about RMDs. We'll talk a little about the history, planning the RMD calculation, the potential penalties which have changed, and then the rules for inherited IRAs. History of RMDs has changed a great deal from 1986 to 2019. Many people I still talk to think it's still 70 and a half, but that changed with the first Secure Act. And in 2020 up to 2022, it was bumped up from 70 and a half to the age of 72. In 23, the Secure Act 2.0 came out. And from 2023, these are for folks who are going to turn 73. In 2023, all the way up to the age or the year 2032, they don't have to start to take an RMD until they're 73 years old. And basically everyone that's born after 1960 is the RMD age is now age 75. So for the most part, if you didn't start taking an RMD yet, you might have to take one this year if you're 73 years old this year. But moving forward, those folks probably already know they've got to take one. And if you don't, please give us a call. We'll help you with it. But for the most part, everybody else has got an RMD age of 75 now, no longer 70 and a half. And understanding the changes and the shifts, I don't want to oversimplify it, but I do have clients who turned 72 last year, now 73 this year, and they might have had to take a distribution last year, or they'll have to take a distribution this year. And that's because of the Secure Act 2.0, which is a tax bill that was modified, the 2020 tax bill that was modified in 2022. Moving forward, some of the strategies that we can talk about managing your RMDs effectively, and the emphasis on timely withdrawals. Excuse me. One of the smartest things that you can do is obviously when you retire, let's just say you're 60 years old, all right? And you've got what I like to call a successful IRA. You've managed to accumulate a good chunk of money in your retirement plan and or your 401k, and now you've retired and you've rolled it over into an IRA, all right? You don't have to wait to start to take money out of that IRA, even if you don't need it, all right? You can and probably should take some distributions from that IRA and either use them or use some of it. What you take out and don't use, you can roll over into a Roth IRA, which from that point forward, that money will never be subject to an RMD, and also will grow tax-free for the rest of its life, and it will pass on to your heirs tax-free, and they may never have to take a distribution from it. So what I'm talking about is taking some of your IRA prior to age of 75, and if you want to, just funnel some of that money into a Roth IRA. So making timely distributions can make sense. Keeping in mind, you don't want to take a distribution that might push you from one tax bracket to the next tax bracket. It's 12, 22, 24, 32, 34, and 36 now. You don't want to happen to be in the 24% tax bracket and then take a distribution out that winds up bumping that distribution into the 32% bracket. Excuse me again. You have to be careful, but you can and do want to take money out of the IRA, and it does make sense prior to the age of 75. There are the uniform lifetime tables. You can get this off the IRS's website. All you have to do is Google the IRS uniform lifetime table, and you can get this chart. You could get this anywhere off the internet. And I'm going to show you an example of an RMD person who's 73 with a $500,000 IRA. Their factor is 24.7. Dividing that into the $500,000 IRA, they're going to have to take a $20,242 RMD for that year. take it out, spend it, you obviously want to pay taxes on it, and or roll it over into a Roth IRA. There are penalties. In other words, there are consequences if you fail to make these distributions. They used to be 50%. They're now 25% under the Secure Act. And ironically, if you realize that you made that mistake within 2 years of making the mistake and you rectify it by taking the balance out, the penalty can be reduced to 10%. And there is some penalty waivers. I won't get into them right now, but you're happy to reach out to us, so we'd be happy to tell you a little bit more about it. So the rules for inherited IRAs have also changed. There are complexities. Spousal inherited IRAs really have not changed. Your spouse can continue the RMDs if they're taking them. If they haven't started RMDs, your spouse can and will more than likely take their distributions and taxable at their individual tax rates. Non-spousal inherited IRAs do have new rules. We used to be able to stretch the distributions out over that beneficiary's lifetime. Now they have to take that money out within a 10-year period, 10-year time frame. We used to believe that, hey, you could wait until the 10th year to take it all out. Now the IRS says no to that. You have to make an effort to take something out each and every year, but you got to empty out that IRA by the 10th year. So there's no more stretch IRAs, which we used to talk about a lot, but no longer do. So I've said a lot. Hope it's been helpful talking about qualified charitable deduction programs and required minimum distributions. I can't stress the fact that everyone needs to have a plan, and a lot of you don't. We're happy to offer you a free complimentary retirement cash flow analysis. All you have to do is reach out to our office, and we'd be happy to put one together for you. You'd have to do a little bit of homework for us, but again, we would be happy to put one together for you. Why would you want to consider the retirement group? We're a group of guys and gals who've been around a long time. We've got a great deal of experience, offices all over the country. We've been working with a lot of Fortune 500 companies over the years, so we've got a lot of knowledge on your pension, your 401k, and even many of your healthcare programs. And again, the complimentary cash flow analysis, take advantage of that. You could follow us on LinkedIn by scanning this QR code here on the left. You can also schedule a meeting with myself or one of my colleagues by scanning the QR code here on the left. Or again, follow us on LinkedIn. We have a very robust LinkedIn page where, amongst other things, we always post a lot of articles. You could find all of us on LinkedIn and follow us as well. You could find our webinar schedules on LinkedIn as well. A lot of great information. I've got a number of clients who follow me and all of the things that the office helps me publish on my page and the firm's page. It's really, really pretty cool. I mean, a lot of great information. So again, I've said a lot in a very short period of time, but I'm going to go ahead and dive back in, bring Sam back on the line with me and see if we've got any good questions.
Alrighty, camera was having a
Sorry about
for a
talking.
second. No problem, Mike. Alrighty. We're just going to answer 2 questions. We want to try to keep it
Okay.
short. I apologize in advance if we don't get to your questions. Please feel free to, you can still leave them in the box and they'll be anonymous, and we will make sure that someone else answers them for you. Alrighty, Mike, number 1, are there any strategies for managing my RMDs so that I'm not forced into a higher tax bracket?
That's a great question. I sort of addressed that early on by starting to take distributions prior to your RMD age. The tables are published. You've got an IRA, let's just say it's $1 million, hypothetically, and you're 60 years old. You never touch it. The rule of 72 is going to double, and then it's going to double again. And in 15 years, next thing you know, you've got $4 million, and you've got to take a $250,000 RMD out, and it might bump you into another tax bracket, and you don't want that. So I can't stress enough, start taking distributions now. If you don't need them, obviously you're not going to spend them. You can obviously gift it away. You could roll it into a Roth IRA. There's a lot of things you can do by keeping your IRA, to keep your IRA down in value that IRA, but obviously have those funds in a Roth IRA or other investment accounts. So yes, you can keep from bumping yourself from one tax bracket to the next. And I have in in my career watched clients who've ignored advice like this, and they've been bumped up by 2 tax brackets, and we're very frustrated. So
Oh,
just reach out and ask us, and we'd be happy to share some more specifics.
not fun when that IRS
No.
comes calling. All right, last one. Should I convert some of my traditional IRA to a Roth to lessen future RMDs?
Yes, I sort of just said that, but yes, I'm a huge fan. You can even start to do that prior to retirement. You could be 45 years old and taking IRA assets that you already have and converting them to a Roth IRA. They'll grow tax-free that from that point forward. Again, you want to be careful because Roth conversions are taxable income. It's layered on top of all of your ordinary income. So again, you don't want to convert too much and bump yourself into another tax bracket. But I'm a huge fan of starting to do Roth conversions sooner rather than later. It makes a ton of sense. And then now you've got multiple buckets of money, and
Mhm.
some of those buckets are growing tax free while your IRA is continuing to grow tax deferred.
Right. And that's a great strategy to use. All righty, Mike, we are done today. That's all the
Thank
time we've
you.
had. We want to thank you for all of your knowledge and advice here today. And thank you, everybody, for joining us. We hope you'll take advantage and make an appointment with us. And we hope to see you on another webinar again very soon. Thanks, everyone. Thank you,
Thanks,
Michael.
everyone. Have a great
Bye.
day.
Bye.